This morning I want to talk about the summary of economic projections, kind of unsurprisingly. That's released following the Fed meeting. The summary of economic projections is really an electronic poll of not just the members of the Federal Open Market Committee and their very large access. They have very large access to economic teams, but also included in that poll is all of the Fed presidents, whether they're in the Open Market Committee or not. And so you've got an enormous amount of resources that are going into providing these forecasts. And what was really, but of course, the actual numbers are nominated by the Fed presidents or the people on the Open Market Committee. And that's important because one of the really interesting questions after, in the press conference, after the decision, when Jay Powell was presenting this to the media, is when is the summary of economic projections made? And the guy who asked the question, who's a mainstream economist, mainstream journalist who's been doing this for a long time, was really surprised to find out that the polls were made not done before the decision, but after the decision, and included the effect of the decision. The forecasts that we've got include the effect of this 75 base, what the Fed thinks is the effect of the 75 basis point rate hike that they've just done. So if we look at where the Fed thinks the US economy is in the long term, it thinks that the longer run growth rate is 1.8%. Now that's lower than the longer run growth rate of the Australian economy by about 80 basis points. And the reason it's lower than the Australian growth rate is because population growth is lower. There is a shortage of the supply of skilled labour in the US economy in the long term. And as opposed to that 1.8% long-term growth, we've been growing a lot faster than that. The US economy's been growing a lot faster than that. It grew 5.5% last year, and it was supposed to grow a bit over 2% this year and next year and the year after. In fact, that's all I've got in my most recent presentation. But the interesting thing is the Fed has revised down that growth rate significantly to just a shade under that long-term growth rate of 1.8%. So it's dropped it down to 1.7% this year and 1.7% next year. And that reflects the slowing of the US economy because of the rate hikes that have just happened in the last two meetings. That's what's actually happening there. And that's the Fed's assessment of that. And as a result of that growth rate being slightly below trend this year and next year, what happens is that unemployment has bottomed out. And what the Fed is actually attempting to engineer is that soft landing that I've been talking about for the last couple of months that I thought was probably the most likely thing to happen, actually. But the Fed is now deliberately attempting to engineer that. So the result of that is, and this is pretty similar to the outlook that I've been presenting for the last few weeks, is that you have a gradual increase in unemployment in the US. So from right now, unemployment's 3.6%, probably get down to 3.5% this year, finishes the year at 3.7%, then rises the year after that at 3.9%, and rides the year after that to 4.1%. And that's the reason that's interesting is because the Fed thinks the long-term average unemployment rate is about 4%. So you're getting unemployment up, and that puts downward pressure on demand, and that puts downward pressure on inflation. And so what happens is that, and remember that the Fed doesn't look at CPI inflation, even though I have to say the CPI inflation rate at the end of last week, it seemed to have had a dramatic shift on where they see economic policy having to go. They see PC inflation this year at 5.2%. PC inflation is usually about 0.5% below CPI inflation. So that 5.2% is equal to a CPI inflation just below 6% this year, is what they think. Next year, they see it falling very significantly to 2.6%, which is kind of, like I say, equivalent to a CPI of about 3.1%. And the year after that, they think that in 2024, inflation will, PCE inflation will fall to 2.2%, which is about 2.7% CPI, and in the long term, 2%, which is 2.5% CPI. So they think that they're engineering this soft landing in the Australian economy, and they think that that's going, and they think that's perfectly achievable. And Jay Powell was asked in the press conference, was he trying to affect a recession to generate the slowdown in inflation? He said he didn't see there was any hint of any US recession, and that's exactly what I think too right now. So as was previously remarked, what this meeting does is the Fed decides to put up rates both further and faster than they previously thought was necessary. But even so, those rates in an historical context are pretty, I mean, they're very high compared to where we were in 2020, when we had the lowest long-term interest rates and short-term interest rates in the entire history of the US financial system since it became an independent country. Rates, short rates and long rates were never ever lower than they were in 2020. You could live about 5 lifetimes and you'll never see interest rates that low again, ever. Compared to that, they anticipate that rates at the end of the Fed funds rate will be at 3.4% by the end of this year. That's 90 basis points higher than they thought. It's actually 150 basis points higher than they thought 3 months ago. 90 basis points higher than I thought that rates would be a month ago. And somebody asked me before I came in, what's the terminal rate? And I said that is to say the maximum rate that the Fed gets rates up to. I said, well, the Fed thinks it's 3.8%, but that number is a full percentage point higher than where they thought 3 months ago. And where is it in 2024 when they've successfully engineered the soft landing? The Fed thinks they've begun to cut rates in 2024, just one rate cut in 2024. They've got unemployment up high enough and inflation low enough to begin cutting rates in 2024. And between the end of 2024 and the long term, they cut rates by about 100 basis points down to long-term average of 2.5%. So my outlook for the last couple of months has been that the US economy will move into a soft landing. The Fed thinks the same in terms of its outlook it's released this morning. It's gradually increasing rates, but the rates are higher, 100 basis points higher than we thought they were a month ago. But the Fed seems to be doing its job. Now, rather unsurprisingly, a number of you rang me yesterday, and I had an interesting yesterday, actually. I actually started by doing a presentation to 60 members of the Denver Business Association. I'm in Denver in Colorado, and it was a fascinating exercise to do. So I kind of got busy with that, and then I got a bunch of phone calls. Okay, so what's actually happening in the fixed interest market is, obviously, long-term interest rates are have gone up dramatically in the last week in response to increased inflation. But the other thing that's happening is, even though the market is selling treasury bonds, it is pushing that money into corporate bonds, and it's buying corporate bonds. And so the result of that is the gap between corporate bonds and federal treasuries has narrowed significantly over the last month. And it's now dropped down to below 2%. So between investment grade bonds is below 2%. Now, what that looks like, if I look like that on the chart, it looks very similar to the situation at the end of January and that we saw through February, where we saw that the corporate bond spread had peaked and was falling very sharply. And that's what happened in February and March. And the result of that is we got a very significant rally in the Australian equities market. We got a reasonable market rally in US equities. So what I find is the combination of the fact that even though bond yields, the Australian 10-year bond yield is now over 4%, there's been a significant decline in corporate spreads, and therefore the amount of additional liquidity in equities markets has actually improved over the last month. And the result of that is that my fair value has only fallen quite slightly from what's in the quarterly, which was, I think, about 7,150, to about 7,090 points right now, which means yesterday at market close, the Australian ASX 200 was 489 points below fair value, which is the cheapest it's been since, like I say, January, February. So we've got a very, very oversold market in Australia, and our fundamentals haven't deteriorated. The fundamentals in the US equities market have deteriorated a bit more. I think it's because there's more growth stocks in there, and that increase in interest rates generates a higher discount rate on stocks, on the growth stocks. But I might talk about that another time as to what's happening in the US market. But again, as I've been saying over the last couple of months, the Australian market is much better value than the US equities market, and as of yesterday's close, it's providing significant value. Like I say, fair value is 7,090 points for the ASX 200, and yesterday's close was 489 points below that fair value.